All right, this is being recorded, and something I mentioned at the beginning of every single webinar is watch this again. The reason why is because, some of these nuances might fly by you the first time. And what I'm going to try to do in this webinar is get you guys to a place where options just make sense. And I think I can do that pretty quickly. I've geared this course specifically to introduce traders like you and investors to options, and I'm sure this floor trader can teach even the savviest of traders a thing or two. So now options can be intimidating, and I'm not going to lie, but we will build from simple concepts to real life examples, and by the end of all of this, I believe you guys are going to have a solid understanding of options. And I think I can do that for you quickly. So let's get on with it without further ado, right? All right, so we're going to be talking about swing trades first off. I'm going to touch on swing trades, how we kind of, recognize a few of these swing trade patterns, and I'm doing them real time, so I'm looking at them on the day of these webinars and trying to figure out which way the market is going to go. But then we need to find the best option strategy for our swing trade. And it's not just saying, hey, we got a bullish assumption, we do the poor man's covered call, or we just go out and buy a call. No, we aren't just narrowing it down to that willy-nilly of a recipe. What we do is we look at what's going on in the options, in the pricing, and that really is the ultimate thing that is going to determine our option strategies. And I'll explain that as we go along a little bit more in detail. But just know, if I have a bullish assumption, I'm just not reaching, into my quiver and grabbing a long call every single time. That's not the way we trade options, because you'll set yourself up for disaster right off the bat if you don't follow some of these guidelines that we're going to set out for you. All right, so let's first talk about swing trades though, and how we do a swing trade more specifically. And when we're looking at this, we first need to figure out what a swing trade is. And ultimately, if we're looking at something that goes like this, we're looking for what is this underlying doing. And they can do all kinds of different patterns, right? And or trends. But what we are looking for in a swing trade is we look for a trend, right? And then we find where the resistance is and the support levels are, okay? And ultimately, we're going to look for where is the pattern inside the trend. For instance, this is a bullish overall trend. We found our support and resistances, and now inside the trend, we have a bullish pattern. And in this case, we have a sideways trend or a neutral trend with a bullish pattern inside, right? And a bearish pattern, bearish trend, I should say. Bearish trend with a bullish pattern inside, okay? So that's what we're looking for in a swing trade. And it doesn't always have to be the bullish pattern, right? We could be looking at something where we were looking at now a neutral trend with a bearish pattern, right? And again, if it was going down, we could be looking at a bearish overall trend with a bearish pattern, okay? So those are kind of what we're looking for in swing trades specifically. But, a lot of you guys look at it and we're saying, it's pretty easy. We can identify those, nothing, support resistances, resistance, support, those all look pretty good, right? But then what happens? We identify something like that, and we've got, say, for instance, a bullish move like this, and we've identified our supports down here and our resistances. We've got an overall bullish trend with a bullish pattern, and then what does it do? Right? And then maybe come back up after you've gotten stopped out, or you have and it does something like that, and then maybe even gaps higher, so then you sell the gap, and then it continues on higher, right? So all of those things will happen, and the problem with just doing swing trades with stocks is you are really beholden to the market as soon as you make that decision, all right? So your risk is pretty high, and your location of your trade is very dependent on your timing. The beauty in options, and I'll get into this a little bit, is you get a little bit more wiggle room when we're playing with options. So we could even see something like this where you could be looking at something like IBM in a case where you found your overall, like this is great for like a low risk trader. You know, you'd go for these further out Fibonacci's, the golden ones that I have here. Inside of that, you can see there's another overall support and resistance that's a little bit more aggressive. And what we have seen, and this is an old trend, and of course, while I was trying to get a new slide in here, we've seen IBM trade all the way up to here. So, you know, I've gotten into a trade based on that setup there, and it continued up. Well, we got another pattern here and has rolled back over. In the meantime, though, if I was doing this with just stocks, I would have gotten a little bit scared maybe when it broke above that area and gotten stopped out and maybe missed the opportunity to come back. But when we're using options, we know we have limited risk in most of these strategies, and we can you know, keep our powder dry, stay in these a little bit longer. But ultimately with this, what I want you to do is you identify the trend, and in this case, our trend is sideways, right? We've got an overall trend going sideways. We've gotten our resistance areas, right? Our support areas. You know, we could say this is the support areas. And then we've got our pattern within the trend. And I'm sorry, I got a little bit overall aggressive there. But ultimately, that's what we're kind of trying to do with these swing trades, is identify that within the patterns. And we'll break that down as we go along here a little bit further. But I've given you 3 things we need to talk about with how to trade using swing trades. Ultimately, we have to identify the trend, right? We find the trend. That is whether it is bullish, market neutral, or bearish, right? And then we need to identify the support and resistances. And that's when we've seen the pattern kind of happen, right? And we want to look for the support and resistances. You know, you could say that that is resistance. We found support. You draw the lines kind of in and around there to find your support and resistances. And then identify the pattern within the trend, okay? And that would be figuring out what's happening within that overall trend there based on your setup. Pretty simple, right? And I'll talk about this in my, here's that chart where it got somehow moved to here, but you can see where I was talking about getting involved more aggressively would have been on this pattern setup right there that I got. Well, I get in a little bit early, and on this one I did. I obviously didn't wait till it got confirmed and it blasted off to the upside. And then we got another one at that golden area. We've seen that act as resistance as well. That got way overdone to the upside. I did add to my position at that level on a short put spread that we talked about, which you can do. And that's another thing that I haven't talked about in many of these swing trade webinars so far is watch your allocation to any one given trade, folks. Don't over allocate to anything at any given time, because if you go all in on something like that move, you would have lost a lot of money. So no matter how sure you are of any given swing trade setup, it is never a given, okay? So make sure you keep your tranche size the same for every given trade, no matter how sure you are. And yeah, there's times where you're going to be like, Wolfman, I should have gone all in on that. And of course, you're going to have that, especially if you've been trading as long as this guy. I mean, that's happened hundreds of times, right? But there's the times that you aren't going to remember, and that's those times that it would have, had you not gotten out, been terribly wrong, okay? So make sure you stick to your guns on that and trade with an allocation that you're comfortable with. If you're trading and you're worried about losing money, that means you're trading too big on that trade, okay? If you're putting that mindset to trading with money as opposed to these are support and resistances, probabilities, and where I'm getting in and out. That's how you should be thinking about trading. If you're still thinking about it as money, then there's a disconnect there, and that's you're being too emotional about these trades. Okay, and again, we've got a bullish, you could say you got a bullish overall trend here, right? And obviously support resistances, you can see the pattern within the trend there, okay? So we're looking for those kind of things. Something like this with Goldman Sachs, they just came out with earnings, knocked it out of the park. We had a bottoming pattern where we've got that doji. The hangman doji came down, clipped that 50-day simple moving average, and bounced away. Yesterday, we got confirmation. Today would be the day that I'm looking, as there's consolidation in this trade, to add a bullish position in this, because I have the overall trend I think is bullish, right? And inside of that trend, I can see the pattern is turning bullish again, all right? And I can see where the support, I can draw a line and see where that it's found that support level at least. I'm going to go with that 50-day simple moving average as my support. If it breaks below that support, that's where I'm pulling the ripcord on it, all right? And resistance would be along that trend line for the upper band, okay? So we can find where those support and resistances will be based on drawing these types of channels around the overall trend, okay? So that's how we're going to set that up. But I see a bullish trend, bullish pattern. I know where my support is. That's going to be where my out is, and looking to get out of this trade when we go up to test. With this trade, because it is a poor man's covered call, if it goes up there and hits my covered call, that's where I'm going to look to get out of this trade. If it doesn't hit that covered call, then I'll probably roll this out in time, lower my overall cost basis. And if you guys have been watching the daily market commentaries, you've seen me do this with several other trades. Lower my overall cost basis, increase that width of the spread, and continue to stay mechanical with it. All right? And I'll show you a couple of different ways to set that trade up when we get into it. And I've gotten a little ahead of myself with options. Why use options? Well, for a few of those reasons that I've already mentioned, but let's just kind of review some of them at this point. These were going to be introductions, but I guess the reviews. But better probabilities, all right? All right, you got better probabilities, or I should have just written odds. Better probabilities. It's going to allow you to keep your powder dry. You're going to be able to stay in this longer. Why? Because you have you're going to have limited risk. If you were looking at most option strategies, especially the ones that we'll talk about, where we have defined risk, well, when you go out there and buy a stock or short a stock, you have unlimited risk really in either direction, all right? Which means, even if you have a stop, you can be like, Wolfman, I always use a stop. Well, stuff like IBM, and other stocks, well, we see them gap up and gap down. Well, a stop is going to get executed at the market, at least if you don't, if you have a stop limit, it might never get executed, okay? So with the options, though, we don't have to worry about it. If it gaps up or down, we've already embedded that limited risk scenario to our trade, which is the beauty in it. So you can have limited risk. Also, your ROI is much better. Your ROI is through the roof with options. Now, think about this. I was going to give you an example of, let's just say a house, since I can't think of how to draw a pen right off the bat real easy. So we got two houses, right? All right. Well, for instance, they should be the same size house. I'm sorry. But anyway, if they were exactly the same, and I paid $1 for this one, and I paid $2 for this one, but I can only sell them for $3, right? Which one would you rather buy to sell for $3? Right? This one. If I can get the same amount when I sell it versus what I would pay, then your return on investment is much better, right? If I can pay $1 and sell it for $3 versus paying $2 and selling it for $3, your return on investment is better. Now you might be thinking, dude, how are you coming up with that? Well, if I were to go out and buy, let's just say 100 XYZ, I'm going to buy 100 XYZ, and let's just say $100 for lack of a better thing here. Well, if I did that, how much is that going to cost me? $10,000, right? Now, if you are on a margin account, all right, it'll cost you $5,000. So on margin, say on marge, you got to put up $5,000, all right? If you were to buy it. Now with options in this trade, our risk is only going to be, if we were to do the same thing, would be only about $2,500 at the max end. All right, that's if you were actually doing a synthetic trade. With this one, it's going to be even lower than that because we are going to limit it. It's going to be about, probably a third of what it would normally cost because we're buying these options. So, options, the call buyer has the right but not the obligation to buy that stock. Now, this is going to be really important because we are also going to sell a call. And the seller of the call has the obligation to deliver that stock, which means if you don't own it, you're short that stock, right? You go out, you got to give them that stock. You got to borrow it from somewhere else. You're short that stock, which could be a headache in some regards. But because we're buying a call, all right, we can offset them because the buyer has the right but not the obligation to buy that stock. So if somebody came in and had your stock called away from you and you didn't really own it, well, you own these options that you'll be able to offset that because then you can go through the exercise process with those calls that you're long and offset the short project or the short one. At the end of the day though, as soon as this trade goes through our short call, we're going to look to cover it. All right. So we're not going to really want to play. There's no reason to be in it any longer than that. That is a winner. All right. And put buyers have the right but not the obligation to sell stock. The seller of the put, though, has the obligation to buy that stock at whatever strike level it is. All right. But we're only going to be dealing with calls. I just want to go over that real quick. I'll talk about the calls a little bit more as we go along here. But the most important thing we need to understand, and remember I mentioned this at the very beginning of the webinar, our pricing is going to determine what our option strategy is. And the reason why is because if options are cheap, what do you want to do? You want to buy them. And if they're expensive, you're going to want to sell them. All right? So, but when you're looking at the option montage, that's not so easy, is it? I mean, if I flip over here to a chart or a page of the options, and I'm looking at all of this stuff, we want to know what Vega is, and that's this number right here. And that's 27.64. Well, what does that mean? It doesn't tell us anything at all. So what we have to do is actually go over to the platform where the charts are, and we need to look at implied volatility. All right? Because implied volatility will tell us if the premiums are expensive or are cheap. And this is just Vega. So when you're looking over at the option montage, Vega is implied volatility. All right? And right here it's right around 27. Okay? So implied volatility is extremely low here for Goldman Sachs. Now, 27 might be really high for something like Johnson & Johnson or something else, right? And, we can see that this high here on this point is about 60. Well, something like Tesla might never get as low as 60, all right? So we have to look at each underlying and see where implied volatility or this Vega number is in relation to the where it's been in the past. And right now I can see that Goldman Sachs with implied volatility or Vega in the option montage at 27 is as low as it's been in the last 52 weeks. So we would say that that is extremely cheap then. Now, but if you want, and I like to eyeball, and I can look at that and say, all right, well, that is about as cheap as premiums are going to get when it's at that low, right? So we can come over here though, and I've talked about this before. I like to discount all of this, pandemic kind of volatility. That was a rare occasion. It's not going to happen again for another probably 10, 15, 20 years maybe. So I'm not going to keep that in mind. I'm going to discount that and look at data from about 6 months on, okay? That seems where we're getting to be a little bit more support and resistance. And you can see I pulled this support down to the very lowest level at this point. You can see where it's broken this support that we've seen in the past. Kind of like the swing trades, right? We can identify these patterns pretty easily where we've got a sideways trend, which is almost what you're always going to see with these because they have a tendency to have a nice range bound area for their volatility, implied volatilities. So we can determine 27 is right here, right? That's the current and the low. The high, I would say, is probably around, let's just say it's 47. It doesn't really matter as those high points. And we take the current, if you really want to dig down on the details here, current minus the low, implied volatility, you take that sum minus the high, IV, and the low. All right, so you divide those by each other, those sums. So we can see the current minus 27 minus 27, right? And then the high minus the low is 47 minus 27. And so we've got 0 over 20, and that equals 0. All right, but what we can see here, and I've mentioned this before, is we find that support and resistance, and even though it's continuing lower, it's still at 0. And it would continue, if it continued higher, it would still be at 100%. That's one of the flaws in this. But at the end of the day, we know that the premiums are extremely cheap. So if premiums are less than, 50%, which this is less than 50%, then we look to buy. All right? And if it's greater than 50%, we obviously want to sell. And, you don't have to always do all the math, right? I mean, I can go like this and draw those support and resistance areas, find out where I am currently, and I can kind of determine, that's the 50% mark, right? And then we could just say, whoops, this is the sell, this is the buy, right? Below and above, okay? But something I want to make sure you guys are keen on with this trade, I'm going to try and use this one. I'm going to use a different page here because what I want to make sure is that the month that we are selling, we want to make sure that when we're trading in these options that we don't have a major difference between the one that we're trading. And you can see the Vega here on this one is 20. The Vega here is 22. So we want to make sure that the difference between those two coefficients on this are going to be pretty tight, all right? So my rule for this is when we're looking at this less than 3% difference, all right, then that is basically a green light. That's what we want, less than 3% difference. If it's 3 to 5% difference, that's basically, you got a big question mark on it, all right? And if it's greater than 5%, that's a no-go. Just stay away from it. If those spreads, and of course I've got it covered up here, but the difference between on this trade that we're looking at for Goldman, the difference in this Vega and the Vega right there, which is covered up, and it is right around 29, just so you know. I made sure of that. So the rule is, less than 3%. Less than 3%, you're all good to go. If it's 3 to 5%, again, the difference between this one. That means increasing, right? 3 to 5% increasing, then that's questionable and a no-go on greater than 5% change between this one and the one that we're trading, okay? So the one that I would be looking to buy and the one that I'm looking to do my covered call strategy in. And we'll break all of that down. But we do know we want to buy these options, right? Because we've determined that they're super duper cheap. And what do I want to do? Well, I can take advantage of the thief in the night sometimes, right? We got to be aware of him. The thief really starts getting aggressive. Is there any reason? Please tell me you guys are still there. The thief gets really aggressive inside of 35 days to expiration, all right? And really limited way out here. So basically, we're going to look to buy out here, and we're going to look to sell. Or sorry, we're looking to sell out here. Sorry, my computer is freaking me out because my pen doesn't work. Sell. And this is our bot. Oh God, Eric. See, I'm so freaked out about this. I can't even think straight. Sorry. You want to buy when you want to limit the thief in the night stealing your premiums, Eric, and you want to sell where the thief comes and steals your premiums. And this is basically theta, or the thief in the night, what we would used to say. And you can see that inside of this 35 days to expiration, now we got my pen back, 35 days to expiration, we can see that that theta really starts eroding. So we want to buy out here to limit that theta decay. It's not binary. It's not equal throughout every single one of these options. As a matter of fact, when we start looking at the options here, we can see that the options right here, about 58 days to expiration to 30 or to 80 days to expiration, the theta only, we're looking at this column here, the theta only increases during these 30 days, right? Only increase by about 1 penny. If we looked at the strikes that are very close, right? These are basically the same strikes. We can see that they should be, we can see that this one only decreases 7 cents a night, this 8 cents a night, right? But what if we were inside of here and buying? Look at that. The theta is almost twice as much. So this is why we don't buy options with 58 days to go either, because we can see that if we got involved in this trade, what's going to happen during that time? That thief is going to get very aggressive, like I showed you in that chart. So if you're buying options, you need to really consider going further out in time. And I like to say you go further out at around 70 days to expiration and further, because you can see what happens between the days outside of 70 days. It doesn't get that aggressive during that time. So you're being a good steward of your capital when you think about these things logically like this, okay? There's a lot of people that talk about buying options in these spot month. And as a matter of fact, I think that's the worst idea ever, just because of that thief, all right? There's a lot of other things we can take advantage of when we buy options out here as well. I talked about Vega. Vega will affect the further duration options more. You can see right here, this Vega coefficient out in time, 75 versus the Vega coefficient inside of that 35 days to expiration, right? So there's a couple of things working for you. You got theta limited, and if volatility expands, because I know it's super cheap right now, right? I know volatility is super low for my underlying. Well, then if volatility expands, I get more bang for my buck. Okay? So ultimately, we want to do the poor man's covered call with this trade because I want to limit some of my risk to the downside. Now, if you were to buy stock, the poor man's covered call will limit your risk to the downside because it's got that embedded stop in it already. And I'll talk about that a little bit further here in a minute, but you don't have to worry about a stop. I know exactly where my risk is limited with this trade. Okay? So we want to talk about delta for a second. Everybody always defines delta as the rate of change of the options premium. Okay, fine, whatever. I say it is data. All right? It's data. It's going to tell us the odds or the probability. The odds or the probabilities. I always say probabilities, but it's easier to write odds than it is to write out probability. All right, the probabilities. All right? Delta will tell us the probabilities of our trade being successful. So a 35 delta says, we can see delta right here. 35 delta says that this option has a 35% probability of being in the money at expiration. All right. This option out here is in the money. It has an 80% probability of being in the money at expiration. Right? Now I had to get to that page a little bit earlier. I was going to pull up my trading platform, but I let the cat out of the bag a little bit early there. All right, so we want to buy an in the money. We're going to set this up by buying the in the money call, which most people would say with the poor man's covered call. They like to go out a year or so on the poor man's covered call. How many of you folks out there do a swing trade that is 2 years long? Probably not. That is more of an investment promise. In that kind of situation, I'd probably tell you to go out and buy this stock if you're going to be in a swing trade that long, okay? I look at swing trades being, probably less than 6 months, maybe to a year, but I'm usually inside of that 6 months wheelhouse because I doubt that I'm in a trade that long, okay, usually, all right? So with that being said, I usually like to go right around, 120 days probably is my wheelhouse. So, but I want to go about, outside of 100 plus days to expiration, something like that. And the short one, we're going to want to look at around that 35 days to expiration, right? Really, this is just outside. Let's just call this outside of 90 days. Because that gets me outside of that theta spiral out of control, right? So 90 days to expiration. You can go further out. I don't have a problem with that. It's just easier if you go to that 90 days to expiration, and this option will then be able to pay for our extrinsic value of the option. All right. Now remember, when we're talking about options, there's in the money options have intrinsic value and extrinsic value. And the intrinsic value, you guys, is really just what the option strike is worth. And when we're looking at the calls, it means what is this call really worth? All right, well, if I buy a call that is in the money, meaning if I buy a call that is below where the current market is trading, that means it has to be worth at least, if not more, than where the current underlying is trading. So in that case, I've got the 300 strike. I can subtract 300 from 338 and see that my options need to be at least, here, I'll just write it up there. $300, you subtract those, $38.92, right? I know that these options have to be worth at least $38.92 because of the benefit that I should receive by owning that in the money option. It has to be worth that, if not more. Now, everything else is extrinsic value. That's theta decay. That's what that thief in the night is going to do and come and steal your premiums, right? So, how do we avoid all of that? Well, here's something, a hack for you. And rather than finding the extrinsic value, 38, 92 minus 440, 70, 60, whatever you want, blah, blah, blah. Look across at the corresponding out of the money put. That gives you a great ballpark estimate as to what the extrinsic value of my option is, all right? So I can just, if I'm buying this one, and I'm always going to go and look for that 80 delta is where I like to start with this. I like to start with looking for that 80 delta, and then I'm going to have to start moving towards those 84-ish deltas, okay? But I like to start with around that 80 delta because it's a little bit less risk, but I also have more extrinsic value of that to pay off. Just so you know, the closer and closer you get at the money, there's more and more extrinsic value. So if I look at my option, look at the corresponding put, I can see like $5.50 or something I've got to pay off. Well, this option doesn't do it. That's not going to cover my extrinsic value. But that one sure does. So, and lo and behold, it's going to generally be right around a 36 delta. So ultimately, we're going out to around 90 some odd days to expiration to do this trade. At least I do. You can go out to, I'll show you how to do it if you like the further durations here in a minute. But I usually like this wheelhouse here because theta decay is a little bit benign yet. And I can pay off my extrinsic value by doing this. So I don't really even have to worry about theta so much anymore because all of that, I'll own this option for the face value, right? If I pay off all the extrinsic value, I own it for the intrinsic value. So you can see I set it up here where I bought one of the 300 calls, sold the 350 call, and did it for $37.90. Now, you can figure out where your break even is real simple with this one. You add the debit in, right? Debit into that, and I got $337, so I got $337.90. So that's where I'm long. That's where I'm synthetically long Goldman Sachs. Well, look where it's currently trading. Last trade. I'm getting this for almost $1 under where the underlying is currently trading. So a couple of things here, right? Had I bought Goldman Sachs, I would have paid up $1. Had I done it with this trade, you know, I get it cheaper, my break even is lower. So that means I've got a little wiggle room before I even have to worry about this trade going underwater, right? When you're doing a trade, a swing trade with buying the stock, you go out there and hope and pray that you just bought the low, right? Well, this, I always feel good because I'm feeling like I'm getting a deal on this. I'm buying it $1 below where the current underlying is trading. If you don't think that's a deal, then I don't know what to tell you. The other thing is I'm getting this for a lot less margin. Now remember, we also said, remember when we were going over our definitions of an option? The call buyer, if I'm buying this call buyer has the right but not the obligation to buy Goldman Sachs at $300. Now, I did have to pay a premium for that, right? I had to pay $37 for it. So that tells me where my break even is. I paid almost $38 for this trade. So, but I have the right but not the obligation to buy Goldman Sachs at $300. That's my synthetic stop, folks. My right, but not the obligation. If this underlying goes below, let's just say for some horrible reason, Goldman Sachs opens up tomorrow at $250. If they had a stop on, right, they bought on a swing trade and they had a stop, it's getting executed tomorrow when the market opens and it could be $250. If it was a stop limit, well, it's not getting executed probably. And for me, I sleep well at night, keep my powder dry, because if it opens up at 250, I'm out at 300 because there's no way I'm buying Goldman Sachs at 300 when it's trading $250, right? Nobody would do that. So I'm not going to, buy it higher. I'm not going to choose to take my right to buy it at a higher level. There's just nobody would do it. So my synthetic stop there is my execution. And another thing, you might be wondering, why is this calculator over here? Because what we need to do is take $37.90, which is that premium, right, that we paid, and divide it by the width of the spread, which is $50. And we need to make sure, well, it's pretty close. I got the 0.6 in there. We're looking for less than 75% the width. Your debit is less than 75% the width. Okay? Now, 75 to 80 is about, that's kind of getting questionable, all right? just to do this. If it's starting to look like this, I'm going to show you what to do. Because what can happen is setting it up like this one. We can see that this one ended up getting a little bit better, right? You can see if you're looking straight to this, you can see 73.8. Well, this is if we're going further out in time. If you want to use options that are further out in time, last example, I used the 92 days to expiration, okay, on my buy. So I was using 92 days to expiration to that 300 delta. Now with this one, we're going to have to look at the 290, all right, the 290 in the money option. So I had to go a little bit closer there, which is fine. And then the other thing is I'm looking at the 290 option, or actually I had to go further in the money, I'm sorry. I went further in the money, closer to that 84 delta, which is fine. But you can see my extrinsic value is a lot bigger. That's going to be a lot harder to pay off. And if I did it to, one of these two strikes, I'm not going to get that full width like I got here, right? I'm not going to get that 75%. It ends up being around 80 something if I try and pay off all of the extrinsic value with this 350 strike, okay? So what I would suggest to do is to do it this way, where I am, we can see it's $7. I'm only paying off 50% of the extrinsic value this go around, all right? Because it allows me to make my width, I want my risk reward to be worth it, right? If I'm paying like 85% the width of these spreads, that's a risk reward that's pretty steep, all right? So with this, I'd like to get it below 75% the width of the spread. So, and that's more, I would rather do that than go for my deltas exactly or pay all the extrinsic value off immediately. So in this case, what we would do is look to be rolling out through the May and the June as we go on through this trade, okay? So if you like to go for a longer duration trade, 150 some odd days or a leap, you're still going to shoot for that 80-ish delta, all right? But then I would say on the first go around, only try and pay off, you try and pay off 50% of the extrinsic value. All right. Pay 50% of the extrinsic value on the first go around. For me, my trades aren't going to last that long. I'm going to go and do the trade where I have a nice wide strategy. Yeah, I'm fudging it a little bit on that 0.6, but that's fine. At the end of the day, if I look at it, I'm getting this underlying $1 cheaper than where it's trading. I'll give up that that 0.6 of a percentage point, right? So to me, this would be the full go. And ultimately, we need to know where we're going to get out. And this is when the pattern's broken, folks. If you are setting this up like what I'm looking at with this trade, I said we've defined basically our supports with, I'm going to call this the support, all right? And our resistance areas, right? We've got the overall trend going through. And I am going to be out if we break a break of the 50-day simple moving average, all right? If we break below that, I'm going to get out. All right, I'm finding that as our support area. Does that make sense? So I write this stuff down, you guys. Setting up a trade based on this, I would say I got set up on this day based on good earnings. Consolidation today based on a confirmed bounce, all right? All of those things I'd write down. And if it breaks the 50-day simple moving average, I'm out. The reason why I write all this stuff down, not only one, because I have data, I can go back and see, where I was right, where I was wrong, all of those things, but I can also stay mechanical. I am not going to fudge on it if I have it written down. I'm holding myself accountable to something, right? If it's in your head, you have a tendency to kind of bend a little bit more than you should, all right? And then that's where you start adding to bad trades or throwing good money at bad money or holding on to it too long, all right? Get out, write it down where your out is. I would say that's probably the most important thing, is make a note where you're going to get out so that you stay mechanical. And that's on a win or a loser, folks. So if my short strike in this strategy gets hit, I'm going to be getting out. So as soon as it trades 350, that's my out to the upside. I can't really, I mean, if I can make more money if I wait to the very last day, maybe, okay? But then there's too many other risks, like the assignment of my short call being in the money, all right? So I go for as soon as it trades 350, that's where my out is to the upside. And if it's going to break my simple day, so 350, the upside we could say is like right in here. And if we break my simple moving average here, I'm out to the downside. All right. So I've got my outs. Write those things down when you're setting it up so that you hold yourself accountable. All right. Otherwise, you'll have a tendency to fudge a little bit. And if you guys need a mentor, I'm here for you. If you guys want to reach out to me, take advantage of this, Pro Trader Strategies, Wolfman's Options Lab, you get everything for 97 bucks per month. If you click on the link, or actually you're going to have to type the link into your URL there. It's hundreds and hundreds of hours, folks, where I've been teaching, and you get all of it. All right. You also get the daily market commentaries, and more importantly, you get a mentor. I'm going to be there for you. If you have any questions, comments, or anything else, you need somebody to talk to, a shoulder to cry on, I'm there for you. I will be there. It says during office hours. Listen, I'm at my desk till about 9 o'clock at night sometimes, looking at charts and doing stuff. If you reach out to me, I will make sure I reach out to you if it's humanly possible. I should say. And if I can't do it in a simple email, I will call you guys. We'll set something up where we do a Zoom and we do screenshots, all that stuff. We'll get you guys taken care of. So make sure you click on that link there. And again, here is the link. If you have any questions, comments, or anything else, reach out to us at 310-598-6677 or trading@protraderstrategies.com. I want to thank you guys all for participating in this and dealing with some of my technical difficulties at the beginning here of the webinar. I appreciate you guys all sticking around. And if you have any questions, throw it in the comments box below. All right. I want to make sure you folks are clear of concept before moving on. And smash that like button. You are limited to those. It really helps me out. I appreciate the kickback or the feedback from you guys. And that's all I got. Until next time, appreciate you guys. And if you can't take that, take it easy.